Hey there, future trading maestros, Jerry here, and today we're diving into the exhilarating world of options trading, specifically focusing on the butterfly spread. This strategy is your ticket to leveling up in the trading game without losing your mind or shirt. Let's break it down, shall we? First off, a butterfly spread is like the Swiss Army knife of option strategies. It combines the power of bull and bear spreads into one, offering a safety net with fixed risks and capped profits. Ideal for those who prefer a market-neutral stance. This strategy shines brightest when the underlying asset remains stable. At its core, the butterfly spread involves 4 options and 3 different strike prices. Picture this: 2 wings and a body where the body is at the money and the wings are equidistant from this central point. Whether you're playing with calls, puts, or a mix, the setup is designed to cater to your speculation on volatility or lack thereof. Now, let's savor the different flavors of butterfly spreads. First, the long call butterfly. Think of it as setting up a net where the maximum profit lands if the stock hovers around your at-the-money calls by expiration. It's like fishing for profits in a calm sea. Second, the short call butterfly. This one's a bit more daring, aiming for maximum profit when the stock price breaks free from our set boundaries. It's for those who like a bit of a chase. Next, we have the long put butterfly and short put butterfly, which mirror their counterparts but with puts. It's like choosing between skiing or snowboarding. Different tools, same exhilarating slope. And then we have the iron butterfly and reverse iron butterfly, which are the heavy metal of the group. Fine-tuned for specific volatility forecast, it's where you put your prediction skills to the ultimate test. And for those diving deeper into investing, I give real-time trade alerts in my Patreon, and if you'd like to try my TradingView custom indicators, there's a free trial link in the description below. With that out of the way, let's go over an example. Imagine Tech Innovations Corp, ticker TIC, is trading at a steady $60. Using a long call butterfly spread, we buy calls at $55 and $65 while selling calls at $60. If TIC stays around $60 by expiration, we're in profit city. But if it strays too far from $60, well, that's where our safety nets, the wings, minimize the fallout. The beauty of the butterfly spread lies in its balance. The risks and rewards are neatly packaged, with profits peaking when the market whispers rather than it shouts. But remember, commissions can nibble at your gains, so keep a keen eye on those. Mastering the butterfly spread is a monumental step in your options trading journey. It's a strategy that teaches patience, precision, and perspective. And as you get comfortable with it, you'll find that the options world is brimming with strategies waiting to be unlocked. Next time, we'll explore the wild territories of ETF options versus index options. Keep it real, and I'll see you in the next video.